Hey, everybody, back again. The Helpful Home Inspector back at you again with another weekly live show. Today, we've got two important people in the room. We got Mark Smith, which has been on the show many times. He's going to be a good co-host. And we have Bill Moeller from Bank 59. I always say Bank High Five. High five. High five. You go over to Bank 59, he'll give you a high five, okay? Now, before we get too far into the depths of the lending process, there is some terms that for those of you that are in the audience that maybe have never bought a house before, have never had a mortgage before, maybe in some cases never had a loan before. Mom and dad might have gave you your first car. Who knows, you know? You need to understand some terms. And as we start talking about Fannie Mae, Freddie Mac, it's a government, you know, they
government secured. They're in conservatorship ever since 2010.
Yeah. But they basically manage lending, and everybody, all the banks pretty much refer to them, and
they make the rules.
They make the rules for the most part. Okay, but one of the things that can be difficult for people to grasp is amortization. It's a big word, and it can be a complicated topic. So like when you look at an amortization schedule, this is an amortization schedule. There's another one. Does that make a lot of sense to you? And this is only the last 26 days of an amortization schedule. Bill's like, yeah, that's my Bible, man. But, you know, in reality, while it is very confusing, there is a common sense approach to what amortization is. You want to try?
Yeah, so basically an amortization schedule, and the way that I would describe it is it's a scale. On the scale, you pay more to interest in the beginning of the cycle. As gradually or time goes on, you will eventually pay more to principal. So, for example, if you took a 30-year amortization schedule at a 6% interest rate, for example, and if you were going to want a basic, really easy way to calculate a mortgage payment, a 6% interest rate is $6 per thousand.
Okay.
That means for every $1,000, it's $6. For every $10, it's $60. For every $100,000, it's $600.
Yep.
So as you get on a scale like that, you'd be 12, 13 years in, and then all of a sudden that level that you're paying to principal reaches the level that you're paying to interest. Mm-hmm. As time goes by, that scale gradually shifts so that now a substantial part of your payment's going to principal. And that's why you hear the proponents out there that you should be getting a 15-year loan if you can, or a 20-year loan, or you should, like we're going to talk about in a couple minutes, the advantages of paying a little extra.
Yeah. Do you want to bring the computer model up again, Tammy? So this is kind of explains how amortization works. So the blue part, that's solid blue there, is the amount of money that you loaned. So you loaned $250 from the bank, $250,000 from the bank. Your payment is the yellow line, okay, or the cost to you. And then the red line is going to be your interest that you're paying to the bank, and the little blue line is the principal that you're paying. In the beginning, you're not paying as much principal as you are interest. The bank's going to get their money first, generally speaking. Mm-hmm. As you move through that calendar of months, okay, then eventually what's going to end up happening is you're going to pay more towards principal than you would towards the interest.
Right.
At the end, your last interest payment is very tiny, and your big principal payment is very large. But that's kind of how that breaks down over the course of 30 years, which is a long time, okay? As far as amortization goes, it just basically depicts that in numbers for you when you look at an amortization schedule. Yep. So you can see after month 243, this is what my mortgage payment is going to be, which is going to be the same throughout generally until you get to those like last couple payments. Sometimes it changes a little bit, right?
Yep.
And then you're going to see how much was going to principal, how much was going toward interest, you know, and that's kind of what that all lays out. The next term is underwriting. Now we talk about these guys like they're little trolls in a room someplace that nobody can ever talk to or see. Do they even exist, you know? And Bill will tell you, yes, they exist. He's probably spoken with some at some point in time. But how do they explain underwriting to people?
Yeah, so basically as a measure of risk, an underwriter is there to assess a few things. One, is the collateral going to be a layer of risk to the borrowing that person the money that they're going to get repaid. Yeah. Secondly is, you got a few other facets. You got assets. Where's your money coming from for your down payment? Is it gifted? Is it, are you power saving it right up to the closing day? Is it money that you had in a 401k? Where did it come from? Mm-hmm. The other one, of course, would be, and the big one is going to be income, because you have so many different types of income.
Oh, yeah.
Mark, you run into people probably that are self-employed. Have you ever had any cases where you had someone that maybe came in and you could tell kind of they're going to need some creative underwriting?
Sure. Yeah, it happens all the time.
Yeah, you know, the creative underwriting piece happens when sometimes someone's self-employed and maybe they've only been in their new business for a year.
Sure.
But they had a history in that type of business before. That's someone that Bank 59 wants to talk to.
Yeah.
You have situations where someone is commission-based, they're overtime, they have a part-time job. We got to look at all that stuff.
They got rental properties, everything else.
We got to look at all that on a case-by-case.
Yeah, and that's really what the underwriter is. He breaks down all the different elements of where the money's coming from, making sure you're a good bet. Making sure the bank is worth betting on you. That you're not
compensating factors.
Yep. Okay, cool. The next thing, title. So title is not necessarily your job, but you guys both deal with the title company very closely.
Right.
The title, how would you explain the title, Mark? What is the title to a homeowner?
So title, for the most part, it's more of a concept of the fact that you have a physical piece that's called a deed. Deed is kind of a piece of paper that says that you are the owner of such property. The title is kind of like the concept that you own it and you have the right to do what you want with that property. So they're kind of tied together, but they're not the same. So deed is actually the actual physical piece that when that's transferred, that gives ownership to the person that you transfer the property to.
Sure. And the title company just verifies that the owner is indeed the owner and that it gets transferred properly to the buyer.
Correct.
Right. Now, in a car lending situation, the bank is listed on the title. In a mortgage, are you listed on the?
No, you're not listed on the deed, but you're listed on the it's called the title commitment. Okay. So you get a title commitment in the mail. You get the actual title work in the mail, usually 2 to 4 weeks after you close, and they record the deed in your name. And the title work is going to list who the lien holder is. It's going to list if there's any encumbrance or any easements. It's going to list the legal description. Sure. And then, like, we have a case where someone's closed on a property on Monday. If there's any back taxes, if the seller didn't pay a contractor, if the seller got in trouble and maybe had a judgment, sure. All that stuff, the title company is going to vet that out so that the buyer that's getting the property realizes the property with a free and clear title.
Yep. Okay. And there's usually title insurance that goes along with all that process, right? Mm-hmm. The next thing, and the before we get into the lending process, is appraisal. Appraisal, again, is not your job nor his job, but you guys both deal closely with that person. Sure. I even bump into once in a while when I'm doing the inspection because they want to try to schedule it all at the same time. But what is the appraisal to you as the bank?
Yeah, so the appraisal to us is really a second set of eyes to make sure that there isn't any safety or structural issues, any deferred maintenance that's going to be a detriment to the value of the property. And then we're also looking at, of course, something that Mark could speak to a little bit as it relates to how you're going to determine the value. And then, the other thing would be you sometimes run into unique properties too.
Sure.
And we got to make sure that the appraiser can actually find like-style properties where the day comes where someone wants to resell that property, we're going to be able to get the transaction, put together where it gets sold.
Sure. And
I was just going to say that we use a lot of different home valuation models in order to come up with comps for our listers and also for our buyers that are looking at property. And it's always nice when you have the valuation systems. Let's say it's a 5-star system and it's 5 out of 5 stars. This is what the valuation is. That means that there's plenty of comps in that area. So if you find a neighborhood that has, let's say it's a single builder and they built all the homes in that area, and there's a record of, let's say, 5 or 6, 7, 8, 10 years of sales. Sure. You've got a really good track record because they're all basically the same homes. Could be 4-bedroom, 2.5 bath, and then we've got a really good comp model there. Where we run into problems with appraisal would be one-off properties, like Bill's saying. You've got like a large piece of property in an urban center, but there's nothing around it that's actually a home. You've got school buildings, you've got manufacturing, you've got things like that. That's where you might run into an issue with appraisals. Sure.
And the interesting thing that'll come in is when you have like someone like myself or Mark, where we're going to get tested, right? Like for example, there's a ranch property for sale right on Washington Avenue in Cedarburg right now. It's a 3-bedroom ranch, but the seller converted the garage into an office space that formerly was used as a dog grooming studio. And now and it's zoned commercial, but they adamantly want to sell it as a residential property that someone's going to live in. Now you look at
going to the community and getting it rezoned.
Yeah, and what's in the proximity of that? There's commercial buildings on either side. You've got the street view. You have a lot of factors. That's going to be something that mortgage companies have to look really closely at, including Fannie Mae, because if that seller defaults, what happens?
You're stuck with the property.
Yeah, and then scratch and dent sale.
Yeah, that's never fun for the bank to deal with either.
Anybody, right?
Yeah.
Good example.
Yeah, exactly. All right, so that is just some terms that are common. If you go to talk to a real estate agent or a lender about your home loan, those are terms that you're going to generally talk quite a bit about. Let's get into the lending process. The first step of the lending process, which we talk about almost every time, is the pre-approval letter. So the pre-approval letter, essential. Okay, this is something you do probably on a daily basis, I would imagine. Okay, what is a pre-approval letter for those of you that have never done it before?
So to anyone that's actually looking to get started, there's these apprehensions. Am I going to be approved? Will I be approved for the amount I desire? Yeah. Oftentimes we see people put the carriage before the horse, and they see the really fancy, shiny car in the showroom, when in reality they should have been looking for one out on the used car lot. Yeah. And that metaphor really applies to the idea that you shouldn't start window shopping or set up a search with Mark until we had a chance to help you gather established credit, established assets, established income. For example, you can be fresh out of college, Matt, and you don't have to have a 2-year work history.
Really? With
your time in school is
nor
treated
a regular employment history.
Yeah, you have to have, if you have a college degree and you can show you have a transcript, you don't need to actually have a 2-year work history. They will treat that as work history.
So how do they count that for income then, though?
So basically, that person would be going into a profession where they're going to get salaried, or they're going to get a full-time 40-hour guaranteed work week with consistent income stream. Yeah. Where you'd run into trouble would be if that person was going to go and have a straight commission job.
Or be self-employed or something
like that. Yes, correct.
Yeah.
So pre-approval, just zooming out for a second just to come back to your original question, would be to basically say, we have a list of criteria that we have to check that we've been elaborating on a little bit a minute ago, and we want to meet that criteria on the pre-approval, and now lenders are having to go a step further. We're actually getting the customer through underwriting right out of the chute, because
in the pre-approval process?
Yes.
Oh, okay.
We're collecting all the documents up front. We're actually going straight at it as if it's a real deal, because we want that buyer to stand out in the space that they're competing with other buyers for the same property. Sure. And so if you have a pre-approval letter from the Rocket or somewhere else where it's honestly not really vetted as much as it could be, everyone's going to be looking at these pre-approvals and scrutinizing them in the case where they have a lot of decisions to make for who they should select as that buyer that wins the bid on that house.
Yeah, the Rocket is basically just a computer vetting the person, where you don't have any person's eyes generally.
I understand they can churn those up pretty fast.
Yeah. As far as the pre-approval letter, very important before you go looking at houses.
Yeah.
Right?
So one of the things for us is we always try to educate all of our buyers that come in. So we actually sit down with them. We have a meeting, kind of discuss what their needs and what their wants are. But the first step in our process is to get pre-approval, and we have our list of people that we choose. Bill is on our list of lenders. I can tell you that the biggest thing as being a listing agent on my side, if I'm working with a seller, let's say I get 5 offers, and let's say 3 of them are exactly the same and at the highest offer, but 2 of them are from a national lender, and 1 of them is from a local lender that is right down the block, or is someone I can walk right into that office.
They can make decisions.
That makes a huge difference. And when we talk to the seller about that, I can tell you from personal experience of working with Bill. Bill's worked tirelessly. I know during weekends, like a lot of these national banks, they'll work from 9 to 5. Some might work during the weekends, but we always tell our buyers that if they are really, really connected with their lender, we ask them, if you're really connected with them, you're going to need their cell phone number, because when we make those decisions and we have to get stuff that's done quickly, we're making our offers on the weekends, Fridays, Saturdays, and Sundays. Well, a lot of those lenders that are national are not necessarily working those hours. I know for sure that Bill is, because I actually had Bill talking with one of our buyers for probably 2.5, 3 hours on a weekend, and it was actually his birthday. So Bill definitely goes.
Talk about commitment.
Yeah, Bill goes out of his way to really help us out, and the idea of having a local lender is a big deal on the seller side. On the buyer side, for us, we need to know what those people can spend, because of the fact that we have to guard against them shopping too high, because let's say that theoretically someone's approved for $300,000. Well, in this market right now, you can't shop at the $300,000 mark, because you have nothing to fight with, because a lot of these offers now are going above asking. Yep. Yeah. So what we say is, hey, let's dial that back down a little bit, maybe shop in the 260 area, 270, and then let's go from there, because you might be able to find exactly the same property, but not at be that top rate.
Yeah, that pre-approval letter is going to lay out what you can afford, generally speaking. And if you push the limits of that, you're pushing the limits of your pocketbook at the same time. Right. So you want to keep that within reason.
There's one other really big distinction I would make, and it's that all lenders right now have to literally go through a process where they're pre-approving a home seller that's going into upsizing or downsizing, basically at a 2-facet process. Because basically, Matt, I'd have to say to you, if you and Patty didn't fall in a spot where you could get your house sold ahead of time, I have to qualify you maybe at a price point maybe that doesn't give you your full affordability potential.
Yeah.
Whereas if you get your house sold, obviously you can afford more. So to some lenders, there's criteria where they have creative ways to do it.
There's two sides of that then.
Yeah, and people have to get through that process without literally feeling like you've just got done running a marathon and you can't run another step, because if a lender doesn't frame that the right way, the way they weave in the two different approaches, someone could get discouraged.
Yeah, yeah. And if all you're doing is checking off boxes on a computer screen, you're not gonna. You're going to feel kind of left on the wayside.
Yeah, so I think we both kind of work really well as a team to help people navigate through those feelings. And even when it was on my birthday and I'm talking to these people, I mean, vividly remember that conversation. They had that deal. They had that situation where they had to buy before they sell.
Yeah.
And you got to basically talk to people about pros and cons of temporarily borrowing against your retirement, hoping you have some money in reserve so that you could maybe make the minimal down payment and then also too wonder, what happens if I have two house payments? How long will that be like that?
And all it gets
or
hairy.
bridge loans too.
Yeah, it gets hairy.
Yeah, so those are all things.
Yeah. Now, with a pre-approval letter, is it a requirement if somebody's paying cash? Like if I sold my house, I made $300,000 on it, and the house I'm buying is $250,000, and I'm going to pay cash.
Yeah. So if you're paying cash, instead of having a pre-approval letter, you'd have to have a proof of funds. So you'd actually have to go to your lender and get an actual document that's from the bank, not something that's made up of somebody's computer, but actually from the bank that's signed, that actually has a live person that's actually signed it that you can get a hold of, that actually shows that you have that money in your accounts and that it's liquid.
So a printout of my checking account won't work.
Not necessarily. I mean,
I would assume it's not.
Yeah, I think the thing is that we have to vet not only the document itself, but also the person standing behind that document to have a just conversation with them. I know from our side, when we're listing a home, when we get offers in, we're calling every single one of those lenders and talking to them about the buyers that they have on their end that they're working.
You're underwriting basically.
We have to do what we have to do to protect our people.
Yeah, I mean the pre-approval letter, you're going to find that people that are if you're going to offer on a home, it's going to be a requirement. Nobody's going to list their house with a real estate agent that's going to accept any offers without some sort of a pre-approval letter or verification of funds.
You have to have that to have it be bona fide.
And most real estate agents, a lot of real estate agents won't even take you looking at houses without a pre-approval letter, because last thing, you go online and you go on Keller Williams, and you can look for houses till you're blue in the face or whatever, and find all kinds of cool houses that you would love to be in. And this real estate agent's going to chase around to 20 houses that you may never be able to afford because you don't know. And that's where there's pre-approval letters very, very important. So that's step one of the home buying process is getting that pre-approval letter.
They have to be ready, willing, and able.
Yep. Now, as far as the pre-approval letter, you're going to need some information. What kind of things do you need from them in order to establish a pre-approval letter from Bank 59?
We need 2 years of employment history, 2 years of residence history. We're looking for a summary of your liquid and non-liquid assets. So that would be checking, savings, 401k, IRA. If you got into Robinhood in 2020, we'll ask you for that. Sure. If you have crypto, that's also another really interesting thing.
You guys use that?
There are some specific set guidelines. In the interest of time, we won't go into too much depth on it right now. But basically, the distinction I would tell anyone that's listening to this podcast, this video, is the distinction of what's called seasoned funds. Seasoned funds is if the money's been in your bank account for at least 60 days. Mm-hmm. The mortgage lender, the underwriter, isn't going to ask you where the money came from. Yeah. The second that money appeared in your bank account and it's over 25% of your gross monthly income, and it landed in your bank account, I'm going to ask you to paper trail it in order for me to show that I can use it. So assets, I'm going to ask you for the 2-year income. I'm going to ask you for 2 years of residence history. That's a high level.
But no, so you're not really using crypto. Like if somebody says, I have $80,000 in crypto, you're like, yeah.
The rumor has it on the West Coast there is a mortgage lender that's not affiliated to Fannie or Freddie that will actually securitize crypto to make mortgages. Maybe years down the line that'll become more commonplace, but it's not really commonplace in the Midwest.
Red flag.
Yeah,
not something I'd want to work with.
And you have to actually liquidate certain assets in order for you to.
And that makes sense. Like if you want the crypto account, you got to liquidate it, put it in your checking account.
Yeah, exactly. And then we're going to paper trail the liquidation of it too.
Sure. Yeah, to prove that it's legit funds.
Yeah. There are occasions where you can, get creative with how you're verifying funds and you can like gifts, certain things. But high level, that's what's going on.
Sure. Now, to get a pre-approval letter, how much does it cost a buyer?
boy, if it costs anything, that buyer should call us.
That's what I would say. I don't think I've ever paid for a pre-approval letter in all the homes.
Lender wants to earn your business. They're going to take you through that process, be a good steward of helping you get educated, and make sure you get a pre-approval in a timely manner.
Yeah, I mean, a lot of when you're choosing the bank to go with, okay, are you going to be able to communicate with the person? Are they available to you? Are they nice to you? Do they seem like they want your business? You know what I mean? And somebody that's going out there wanting to charge you $150 for a pre-approval letter is not somebody that wants your business.
Well, credit reports tripled in cost this year,
I bet.
at the beginning of the year. So some lenders are really, it's starting to factor into their cost of doing business for how much a credit report costs now.
Yeah.
And
I don't know. I have feelings about credit reports and all that kind of stuff. How it would, they're managed by outside companies and they can make money off of my credit score. And I mean, it's just kind of a crazy concept, but it's reality.
They're going to get more regulated here coming up, and there's going to be some changes to the FICO scoring model by 2025. Right now there's 3 major credit bureaus: TransUnion, Equifax, and Experian. Yep. There is talk that they're going to eventually have some reform around that area. I won't go into more depth than that at this point.
Yeah, I mean, they're an outside business, so they have to be paid for their work and stuff. But we gotta, also keep it real. These are people's scores and stuff that you're making money off of. So, with that, as far as the pre-approval letter goes, when you get a pre-approval letter from a bank, is it a commitment to the bank at some kind or at some level?
It's really not a commitment in that there are still some facets to the transaction that could impact whether or not you go to a successful closing. You could have a title issue.
Okay.
You could have an appraisal issue.
Well, and you talked about starting underwriting as part of the process too, so that is even more in depth than just what used to be just a surface.
Yeah, and there are some lenders that are getting really creative in the way that they guarantee that you're going to go to a successful closing, or they will basically put their some dollars behind it.
Sure.
But basically, ultimately, from the standpoint of the vetting process, you get as far as you can ahead of knowing what's on title, ahead of knowing could there be something going on with the collateral, and you get that vetted out as best as you can.
Yeah, it's not an absolute commitment, but you got to look at this. This person is doing work for you at no cost to you, generally speaking. And I mean, while you don't actually owe them the farm, you do owe them a little bit of loyalty as long as they've gone out there and done the work for you. Just like a real estate agent goes out and shows you 40 houses, okay, and they get paid nothing for showing you 40 houses. And then, I found my neighbor down the street that wants me to buy her house. And it's like, I just spent how many weekends with you? I mean, Mark, you got to know that's a thing. Here's the thing.
It happens. We do everything in good faith, right? The idea is that if you can help people and educate them and help them through, it's all going to come back at some point.
Yeah, exactly.
Yeah.
All right. The next thing we got to talk a little bit about is when, as a matter of the pre-approval letter, it comes in a digital form, or is it something you got to pick up the bank and get signed, or?
No, at this point, we're doing pre-approvals on the fly to the point where, let's say, Matt, you come to me and I'm able to run a credit report literally on the fly. I could be doing a pre-approval in the car.
On your birthday.
I have my laptop with me. I can do the pre-approval within minutes because I have the credit report. Obviously, when I say minutes, I'm able to check all the boxes and solidify all the details.
Sure.
So basically, an average pre-approval without exaggerating takes about an hour.
Yeah. And how long is it good for generally?
120 days.
120 days. So and you have 3 months or 4 months to go out and find your house.
And when we had a little bit more of the volatility, that 120 days, even though that's what the letter's for on the bank side, for us as a listing agent, we'd probably look for something that's a little shorter. So we might even ask for something that's a little bit more current because the volatility, when it's going up a half to a full percent, or then you're worried more about that, because if they're already at the top end and that interest rate went up another percent, we have to protect our sellers and say, hey, do you mind getting an updated pre-approval letter?
Yeah,
just to make sure, because we want to make sure that both sides know what's going on.
Yep. Well, and sometimes it takes a year to find your house in this current market where there's not as many houses available. It might take a long time. In which case, they just call you back up and say, hey, I need to update my pre-approval letter or whatever. I'm getting close to that 120 days. And I'm assuming it's a little bit easier, right?
Yeah, it is, because you already have everything in your system. Yeah. The sales cycle does cause us to fall into a place, though, sometimes where, like, we have a customer that will be, it would be 30 to 60 days, they'd be under contract. Sure. Now it could be anywhere between 6 to 12 months, depending on the client and their expectations. Yeah. And it could be Saturday night at 6 o'clock, and I'm saying to the person, I got to repull your credit right now, Mr. Customer. And all of a sudden, they maxed out their credit cards. And if I didn't repull their credit, I would be doing Mark's seller a disservice.
Yeah, because when you get to closing, you're gonna have a problem because
you're not gonna get to closing.
They verify they verify your funds and everything right up to the last day before closing. And if you screwed up and went out and bought a $80,000 car, that's gonna screw things up.
We always tell people they're gonna buy a vehicle between accepted offer and closing. You might want to make it a van because you're gonna be living in it.
Maybe down by the river.
Right.
Yeah. Now, getting a pre-approval letter, running credit scores mildly affects your credit score ish.
There's a common misconception that you can't go to multiple lenders, and to be impartial for the audience and just to, not have a bias, I will say you are allowed to shop for a mortgage. It says so right on the CFPB website. You can shop for a mortgage for 30 days and actually have multiple credit checks done by lenders, and it's only treated as one inquiry.
Oh, okay.
And as far as I can see, I see people that go and get multiple credit card checks to save money get a discount on your stuff at Macy's or whatever.
Kohl's or wherever, yeah.
Yep. Those are counted one for one. So you shouldn't see a drastic difference. If you do, it's going to be less than 10 points, and after 1 month, it'll rebound.
Sure.
The other thing too, we always say, well, what are you waiting? What are you holding on to that credit for? Because if you're worried about your credit getting nicked, well, what are you saving that credit score for? It's to buy a house, your biggest investment, right?
Yeah.
So.
Yeah, get in on it.
Right.
All right. So that is the pre-approval letter. Very important first step of going out and looking for a home, going out and looking and getting that mortgage process started. The pre-approval letter is essential. All right. Now, as far as the process goes, after you get your pre-approval letter, you find your real estate agent. You're going to go out and you're going to start looking at properties. You're going to find that dream house, and you're going to put in an offer and hopefully get an accepted offer. Now, that accepted offer, while it doesn't always come as easily as we make it sound, it is a lot of work in getting there. So you may have to go look at a bunch of houses. You may look at a bunch of pigs with lipstick on it, but hopefully you'll find a dream house in that bundle. After you find that dream house, get that accepted offer, then you're going to make the bank aware that you have an accepted offer, and you're going to want to lock in your rate, right?
Yep.
Locking in a rate, how far in advance can we lock in a rate?
Generally speaking, 45 to 60 days. And the longer you ask the lender to commit to the rate lock, that will also cause your interest rate to be slightly higher in most cases.
Okay. All right, cool. And locking in that interest rate, you guys just guarantee that that's going to be the interest rate that you pay at closing as long as your closing falls within that window, correct?
Yeah. And a lot of times right now, customers are asking us if we can float down.
Oh, okay.
So that would basically mean if, let's say, interest rates go down a quarter, 3/8 of a point over the course of the transaction, it's popular for a good lender to be able to help the customer, educate them to know what makes interest rates tick. Right now, the 30-year fixed rate mortgages follow the 10-year treasury yield pretty closely.
Okay.
So like today, for example, on April 18th, the 10-year treasury yield was at 3.59 today. Okay. The lower the yield goes, the lower interest rates go.
Automatically?
It'll follow, it'll trend with it.
Okay.
So for anyone in the audience that wants to know like where rates are headed, you can look at the 10-year treasury yield. You can just Google it. You can go on CNBC, Market Watch. You can just pick one, and you can just kind of gauge that. That's a good way to look at it. But we're helping people understand how rates tick. Is there anything on the economic calendar that's going to influence the direction of interest rates?
Yeah. Now, all of these things you guys are happening very quickly in the very beginning of you getting your accepted offer. So you have your accepted offer. You let your bank know you're going to get your lock in your rate and stuff. You're going to pay your earnest money, which back when we bought ours, we had to find our checkbook. I don't even know where I'd find it today. It's in a drawer someplace. But nobody writes checks for that anymore. It's all basically credit card usually, I believe, right?
Actually, we have a couple different ways we can do it. But basically, earnest money is traditionally between 1% and 2% of the purchase price of the property. Yep. So let's say it's a $300,000 house. Your earnest money would normally be about $3,000. If you want to make a really strong offer and up your earnest money, you could do that. Yep. It's due within 5 days of that offer being accepted. So you don't actually have to send the money in when you put the offer in. It's when it becomes accepted. Yep. So you have 5 days, and that includes postmarked up to 5 days. So if it doesn't get there until the week after, but it's postmarked on that 5th day, you're still okay. But yeah, we generally now a lot of the buyers are using something called trust funds electronically.
Sure, electronic just transfer. Sure. And earnest money, you guys, if earnest money basically is if you back out of the deal that is no fault of the sellers and you just bail out on the thing, they automatically get your earnest money. It gets
I mean,
of them.
Yeah, pretty much. We always say it's got to be for cause, right? So there's got to be something with the contingencies that you already have on the offer. If you were to walk away, the one thing we did notice is that there are some sellers though that like the idea of having a mortgage versus cash buyers. There are some cash buyers that have so much cash that if they lose out on their earnest money, they don't really care. You always wonder if in that 30-day period they might find another property and say, you know what, I'll forego that. They can keep my earnest money. I'm going to go find something else.
Crappy because you made a commitment,
right? But when you have somebody who's under a mortgage and they work their tail off and they've worked with a lender and they worked with an agent and they said, hey, we're going to put this forward and we're going to get financing through a mortgage. Sometimes they're tied in a little heavier.
Yeah, and as long as everything goes as planned, that earnest money comes off of the balance that you owe on the loan. It comes off to or your down payment,
so basically that money will go to the trust company of the listing agent. Let's say somebody made an offer on a home that we were listing. It would go to our Keller Williams Trust. It would sit there until closing, and at closing it actually goes to the table, gets put into their down payment for the buyer.
Excellent. Cool.
Yeah, we're going to verify those funds too.
Yeah, exactly. And now after we've got the earnest money taken care of, you're going to get your inspection done, and then you negotiate any findings that come up as a result of that. The inspection thing has been kind of a little wishy-washy lately. Hopefully that will change as the market balances out, but we'll see what happens with that. And then you're going to get your appraisal done. Now, you usually want to have your bank wait until after the inspection and after that negotiating process to get the appraisal done, because if the appraiser goes in, you're spending that, what is it, $450 these days?
That's a good estimate of an appraisal cost. Yeah,
you spend about $450 on the appraisal, and that is your buyer's expense. It's not something the bank pays. It's not something the seller pays. It's something that you pay. And if that happened on a home that you get through the inspection, you find it had all kinds of foundation problems, whatever, and things didn't negotiate out, and the appraisal was done before the inspection, you're still stuck paying that $450 generally, right?
I believe as soon as they're doing the appraisal, they're going to be deducting that $450.
So the appraiser is going to charge a trip fee if they drive out to the property, and if they inspect it, but they don't actually deliver the report, they're probably going to still hit you for the full cost because they did the due diligence ahead of going out there.
They still went out there.
And we're also in situations too where the dates and deadlines on these transactions. I mean, we've got some deals that have to close in 14 to 25 days.
Holy cow!
And we got so day one could be a Monday, and we got to get the appraisal ordered right alongside the home inspection being arranged with you or something like that, and then we're gonna just tell the buyer this is what it is.
Yeah. So that is the appraisal. Then the title is title kind of. As soon as the accepted offer comes in, the title starts working on it, right?
Yeah. So a lot of times for our listings, we're using Focus Title, and they do a great job. But I always tell everybody when we're discussing the education of what the title company does, I always tell them it's kind of like the Wizard of Oz. It's like, there's something happening behind the curtain, but we're not really sure. They're doing a ton of steps behind a
30-year search.
Yeah, and they're doing all this due diligence and making sure they get making sure that there's no liens on the property, make sure that the deed's able to be transferred, all those things, all those steps that they're doing behind the curtain. We don't really see it, but all of a sudden they're ready to go.
We're going to find out. Yeah. We're going to have Sarah Weisman on the show in a few weeks or whatever from Lakefront Title. And we're going to get into it with her. I want to find out what they do.
They do a ton.
But so that's a important step is the title, but it does take a little bit of time. You just want to make sure that all your ducks are in a row by the time you get to closing. Financing gets confirmed through underwriting, usually a week before closing?
You hope you're clear to close at least 3 to 5 days before closing, because that's the last thing the buyer remembers is how they got to the closing table, that they didn't crash land the plane. You basically you could have scenarios where the buyer's getting a gift from, you get the trifecta. You got the buyer that is power saving a portion of their down payment, some other money is coming in from a gift, and you got work orders or repairs on the property where you got to get lien waivers and invoices. And all of a sudden you're chasing all this stuff down right up to closing day, and then the buyer is frantically hoping to get their final dollar figure. These are all things that we try to avoid, or we just try to be proactive about
stress
on the front end. And you just make sure buyers understand up front what's all at play.
Yeah, there's a lot going into it. And then before you show up for closing, you always got to make sure that you secure your homeowners insurance, which we're going to have Dan McLeod from Colonial Insurance. He's a mortgage broker. He's not a broker. He's a insurance broker. He's going to come in here and talk to us about homeowners insurance and that kind of stuff, what they cover, how you get that, all that kind of jazz. So he's going to come in and talk about that. And before you go to closing, you got to make sure all these ducks are in a row, and that's really where your agent comes in. The bank's they're all communicating in the background, usually not necessarily with you, but they're all communicating to make sure that things go smoothly for you. So that's why it's important to have a good team put together, and they are a team. So when you go to the Smith team and you're looking at houses and stuff, they're going to give you recommendations for who to go work with. because they know that they have a good relationship with them and they know that they're going to do everything that they can to get that to go smoothly for you and come together.
Yeah, 100%. I think the idea of trust and communication when you have something going down, you've got everybody's best interest at heart. You're trying to make sure you're taking care of all those people. Yep. It's always good to refer to really good people and have really good people on your side. So,
exactly. But lots of great stuff here today, you guys. If you have interest in getting a mortgage or looking at a home, talk to these two guys. Mark Smith is your real estate agent. Give him a call. Smith Team Wisconsin. They're on our website, but you can also look them up on Keller Williams, and then also Bill Moeller from Bank 59. If you're looking for a mortgage, talk to this guy. He's local. He's here to help you out and advise you. And even if you don't decide to go with him or whatever, he'd be loving to talk to you and give you some of his information that he's got in that big brain of his. Any last comments, guys?
Go with Team Smith. Make your dreams a realty.
Ooh, he's got a tagline.
Better believe it.
Bank 59, making lives better.
Nice. Yes. All right. That's the show for today, you guys. Thanks again for tuning in. This is the Helpful Home Inspector, Matt Yates, coming at you live from Hartford. We'll see you next week. Have a good one. Remember, you guys, the better you take care of your house, the better it's going to take care of you. Hey, thanks for tuning in today, you guys. If you like this video, please give us a thumbs up. If you want to know when we put out the next one, give me a bell notification. It's a little bell on the bottom right-hand side. And subscribe. You want to know when I'm coming out with new stuff or whatever. You want to be able to check us out and be alerted to new video content coming your way. Subscribe button's really the way to go. Thanks again for tuning in, you guys. Remember, the better you take care of your house, the better it's going to take care of you. Have a good one.